Why is the Fed nationalizing money markets? Is your money safe? What does this have to do with negative interest rates? And what is the bond market telling us today? Answer to those questions more on today's Macro Show. I'm your host, Steven Van Metre, and we're out at the racetrack today because, as I said, I told you this, the bond market was about to take off, and sure enough, it's off to the races, and it's only beginning. So today, we're going to go through what the bond market is telling us about how all these things with the Fed was attempting to nationalize money markets, what it actually means, what you need to worry about, what you don't need to worry about, and more importantly, what's about to happen. Now let's start with a story. We have to go and rewind to what is QE trying to do. And the most important thing to understand about quantitative easing is it's designed to suppress and lower interest rates. That's what it's designed to do. And it causes, one of the effects of that, it causes a buildup of cash in the financial system. Now, if you're trying to figure out why that is, it's really simple. As rates get suppressed, savers run out of alternatives. So when people save money, they start saving their savings account, and as that builds up, they will look to alternatives, perhaps money markets, CDs, maybe short-term bonds, and other type of investments. But when interest rates get suppressed to near zero, savers really don't have any alternatives. They look for alternatives, and the trade-off for tying their money up isn't worth the extra interest they're likely to get. So they choose to not do anything and leave it in savings. And so you get this buildup of cash in the financial system, which from the Fed's perspective and what QE does, it needs cash. So it creates a feedback loop that quantitative easing eats cash, as we've talked about that in the past, and it creates the cash that it needs. So it's really very interesting of what's going on. And as cash rises in banks, well, the banks run into a problem. Now, how do we know that QE does this? Well, there's a really simple way to find out, and we can go look at this chart right here that shows cash assets at all commercial banks. Now, if I was to extend this to the left, well, you would see that it's fairly flat for decades. And all of a sudden, quantitative easing comes along, and boom, cash assets go up. Quantitative easing 2, boom. Quantitative easing 3, tapering, and now QE4, QE infinity, I don't even know what we're calling it, but there's the evidence to support that. Now, the challenge for banks is they're required to follow regulations from the post-Great Financial Crisis rules, which are called the Basel III regulations. And in Basel III, it penalizes banks for expanding their balance sheet. And one of the things it penalizes them for is increasing the cash, because as customer cash goes up, well, so too does their balance sheet. And we've talked about this in the past, but let me show you where this is. And this you can see in their GSIB score. So we can go to this website here that is the Office of Financial Research, and they show the bank systemic risk monitors along with some other things. And here's the GSIB surcharges. And you can see, for example, JP Morgan Chase has the worst. It has a penalty of 3.5% compared to some of the other banks. So as banks get bigger, they get penalized, and so they're highly incentivized to want to get rid of this cash because they don't really have a whole lot of control over it. So quantitative easing is creating this excess cash, which is penalizing the banks. So when banks are facing a balance sheet that's growing against these regulations that are designed to keep them from growing, what else can they do? And that is to cut lending. And that's important to understand. So, because lending also expands their balance sheet. So what do you do when you've got too much cash? Well, you cut your lending, which isn't exactly the right answer, but that's what they do anyways. So we also then saw stimulus start to show up. And we know from the data that somewhere around 30% of the early stimulus checks went right into savings. And as more checks went out over time, a greater percentage shows up into savings. So maybe now closer to 40% of money gets saved, which causes the bank's balance sheets to go up and more money to pile up into savings accounts. And what does that do to interest rates? Well, it drives them down because cash is just piling up in the banking system. So there was a problem because savers started looking at alternatives, and the only alternative they found was money markets. It didn't pay a whole lot more, but they said, we're going to pile into money markets. Now, we've talked about this in a recent show, Money Market Rule 2A-7 from 2016, that effectively took all money markets and tied them to short-term treasury bills, which is great because as money flooded into the money markets, what happened to short-term rates is they went down and almost went negative. I mean, they briefly just touched there. And so the Fed had to step in and say, look, we have a fix for this. And what they did was they set the overnight repurchase program or overnight repo rate, the interest rate, to 0%. And the Fed said, okay, if this thing's going to go negative, we'll put a floor at 0. Now, for those of you who do not understand what the overnight repurchase program is or how it works, let me give you a brief explanation of it. What happens is you can take, for example, a bank or a money market fund who has cash and is in desperate need for treasury securities, and it's an overnight loan. So the Fed loans them treasury securities, and it takes their cash and it pays them interest on that cash while they have it. Now, the rate of 0 isn't much. In fact, it's nothing. So at first, this did a little bit to help the situation, but it didn't work. And what happened ultimately is more money kept piling into money markets and rates get shoved down again, and it forced the Fed to react. And what they did was raise the overnight repurchase rate to 0.05%, or what's called 5 basis points. Meaning, when these money market funds and banks loan their money to the Fed for the overnight, they receive 0.05% on an annualized basis. Again, not a ton of money, but the bank paid them for that privilege to hold their money. And again, in exchange, the Fed lent them treasury securities. Now, there's a lot of debate and a lot of question over why the Fed doesn't stipulate what treasury security it's lending. Well, let me give you a very simple explanation because it doesn't actually matter. Everyone's worried, is it notes or bills or bonds or what? It's actually could be any of them. And here's why. Let's pretend that I have a 3-year lease on a car. At the end of the 3rd year, I have to return the car. So my loan or my term with this car is 3 years. Now let's say I lend the car to you for the night. Do you get a 3-year term? No, your term is overnight. That is a key part here. So the Fed can effectively take a 30-year bond on its balance sheet and turn it into an overnight security to the banks and the money market funds or whoever else is participating in these overnight repurchase agreements. And this is beautiful because it takes all of that cash, pulls it out of the system, puts it on the Fed's balance sheet, and it's designed to keep rates from going negative because they almost did. And that's what's important to understand, that this overnight repurchase program is designed to keep rates from going negative. So the Fed raised the rate to 5 basis points or 0.05%. And all of a sudden, there's a relief, a pressure valve released on the system because all of a sudden, the banks saw a way to shrink their balance sheets. How are they going to do that? Well, they're going to encourage their customers to take their savings and put it into money market. And there's some ways they can do that. One, it's due to the higher rate money markets are paying. The second is they can just send out a note to their customers that said, on this certain date, your savings account will be converted to a money market savings account. Now, why would that be important? Well, because all of a sudden money market mutual funds are dumping all of their cash onto the Fed to get that 5 basis points, which is pretty much better than they can get anywhere else. In fact, it was more than they were getting from T-bills. So the money market funds are thrilled. They've got effectively a guaranteed rate. And in terms of their compliance with money market fund rule 2A-7, they're in perfect compliance with it because the overnight repurchase program is perfectly to the letter following all the regulations that money market funds need to follow. So the money market funds are excited. They've got a guaranteed rate. Then as their T-bills mature, they unload them. The banks, who are desperate for pristine collateral, which we've talked about, are buying up those T-bills. All of them, meanwhile, they're trying to shove their clients over to the money market funds, knowing that the Fed's got it. Now, at the current rate of this, it is highly likely the Fed could take over every money market fund, meaning that everybody that has $1 in money markets will have that money backed 100% by the Fed. Now, is that a problem? Not at all. In fact, the Fed is perfectly designed to handle this issue. In fact, if you have money in money market funds, you should have no reason to worry. It's what's going to happen outside of money markets that should cause you to worry, and we're going to talk about that. So now, all of a sudden, there's been some pressure relief, and you can see this increase in demand for reverse repo right here. And every day, the New York Fed posts the results of the reverse repo operation, and this dipped into the 700s last week and is now back up to $860 billion, almost $860.5 billion. And if you recall from our conversations about the research from Zoltan Prozar of Credit Suisse, who is considered one of the foremost experts on the banking system, he said this number is going to explode to potentially over $2 trillion in the next couple of months. That's the danger. I'm going to show you why you should be really concerned about that. So now we have the situation where it appears that money markets could be entirely backstopped by the Fed, and that's causing long-term interest rates to fall. The question we're going to try to answer is, why? But let me show you, because we've looked at this chart before, and here you see overnight repurchase agreements in blue and 30-year Treasury yields in red. And so we know when reverse repo starts to become a problem, it puts downward pressure on yields, and then it kind of cooled off, and then yields were just too high, and financial conditions tightened. And then we saw yields spike up, reverse repo followed it, yields come down. Now, reverse repo is going up a ridiculous amount, and it's putting downward pressure on the long end of the curve. The question again, why is this happening? And this, we now have to start to understand the supply and demand for interest rates and loans. And so what's happening is there's too much money on the short end of the curve. And what I mean by this has a demand for short-term interest rates, because people in money markets could demand all of their money the very next day, so it needs to be extremely liquid. You could not tie that up, say, with a 30-year bond. So there's this demand, a heavy demand on the short end of the curve, and at the same time, lending growth is contracting. Now, I'm going to show you this chart here, because this is also important to the picture. Is here's loans and leases and bank credit, all commercial banks. The year-over-year rate of change is negative, minus 4.2% as of last week. The 6-month and 3-month rate of change are effectively at zero, showing no growth in lending. So that is also key to understanding what the problem is here. And so we know long rates are falling. But why? It's because the Fed tightened. Did you miss it? We covered it just a moment ago. Remember, so when the Fed took the overnight reverse repo from 0 to 0.05, did they not raise rates? And isn't that tightening? It is. And that starts to answer some of the question of what's going on. Because when you have a lot of money piling up in the front end, the short-term overnight markets, like money market savings accounts, what you need is to get that money moving or get it lent out. That's what you really need to see it happen. So how would you do that? How would you get that money to move? Well, if the Fed wasn't backstopping the money markets, you'd see rates go negative on the front end of the curve. And that would be okay, because what it would mean is depositors are paying the banks to hold their money. And that would be an incentive to get rid of it. It would also mean the banks could lend out at negative rates. And you say, wait a minute. Banks would lend out at negative rates. Wouldn't the banks lose money? How would the banks lose money? It's the depositors that are taking the hit. Because if you had your money in the bank and you were paying the bank to deposit there, and the bank was lending out at negative rate, the bank's still making money on the origination of the loan and its fees. It's the depositors who are losing money. So that would be the solution. If rates went negative on the front of the curve, people would want to borrow more on the short end, people would be incentivized to get their money out of the banks, and that would put upward pressure on yields and solve the problem. The Fed said, no, we're not going to do that because we need to backstop the system, because breaking the buck, not an option. We can't do that. So we're going to set the overnight repo rate at 5 basis points. The banks are saying, phenomenal, this is great news. We'll offload as much of our savings deposits onto the money markets. The money markets will offload their T-bills so we can buy them because we're desperate for that. And the money markets can go and find their safe home with the Fed. and everybody wins. In fact, it almost sounds too brilliant to be true, but it is. It's absolutely brilliant how well the system is working. Except the Fed tightened. So now what's happening, rather than having all of this money at the front of the curve leave, it's attracting more money because it's paying a higher rate. And so all of a sudden, the long end of the curve has to go down. There we go. The long end of the curve has to go down because financial conditions are tightening. So we need to find borrowers, and so the intermediate and long-term rate yields have to fall because the Fed's tightening the front end of the curve. And so this starts to make sense of why the Fed is doing this. And now I want to show you the overlay of lending against this, because now the big picture will start to come together. So let's go back to this overnight repo chart, and now we're going to overlay loans and leases and bank credit. And so here you see this buildup of cash in 2016. In fact, we should probably, let's see if I can, can't turn off the thing that I meant to. Anyways, you see the overnight, the cash building up, but loans and leases, the red line, we're running, at a rate of around, 4 to 5% a year, mid 3s to 5% a year over-year rate of change. And eventually the loan sucked up all that cash. It said, okay, and now there wasn't a problem. Reverse repo went away. Loans and leases were consistent around that 4 to 5% range. Everything was fine. Here you see that blow up in overnight reverse repo. And look what happened. There was a surge of lending, mopped up that money. Now you see the reverse repo problem go away, lending falling, contraction, somewhere right here at this level, contracts, and still in contraction. Now the problem is there isn't money to mop up, or there isn't lending demand to mop up all this money, and we're on the edge of seeing a huge surge in overnight repo due to the fact that Zoltan Prozar said that, hey, all these money market funds have a huge incentive to go to the overnight repo program because they can get a higher yield than T-bills, so they're going to take it, plus it's guaranteed. Why wouldn't they do it? And there's trillions more to come. So when you see there's trillions more flooding into money markets, which is going to get flooded into overnight repo, and all of a sudden, boom, now it makes sense of why there is a decline in the intermediate and long-term yields. It's because the Fed is tightening the front of the curve, so the long end must fall to reduce the pressure. So that's why you have no reason to worry about your money market account. If you have money there, it's not a problem. The Fed's got it. It's fully liquid the next day because that's how overnight repo works. In terms of negative rates, well, the Fed has done their job. They've starved off negative rates, and instead they're going to drop long rates down inadvertently, not to mention the fact that they're still doing quantitative easing, and there's no sign that that pace is going to slow down. In fact, I would make the argument that due to the decline in treasury yields, all this taper talk is going to go away because we know the consumer price index is going to fall along with yields, and that means the probabilities lie that the Fed's going to do more QE, creating more money in cash and putting more downward pressure on the long end of the curve. I hope this is starting to make sense, because now we need to talk about what the bond market is telling us and what your real risk as an investor is. Because if you're just looking at this saying, oh, well, my money in money market's fine because Steve said so and the Fed can back it and there's nothing to worry about, that's not what your real risk is. In fact, that would be a good problem to have, is that you don't have to worry about it. Let's look at the bond market, because you know what? It's almost time to put the crown on. And here we have the 30-year treasury yields. And what happened is a big drop today. We'll zoom in. We're looking at a chart there. So it crashed down to this roughly low 1.8. And if we zoom back out to the 2-year chart, what does that tell us? Well, we know this is a level of support, but it doesn't really last that long. The next destination, it could back up. I'm not saying it won't. The next destination on the way down is into this, say, 1.6 range. From 1.6, you go back and look. What happens when it gets to 1.6? Well, it generally makes a move back down to 1.2. If it fails to hold there, now you're going to see new all-time lows in 30-year yields. And that means financial conditions are tightening, And it makes sense because the Fed tightened financial conditions on the front of the curve. The pressure building on the front of the curve cannot be released. The banks are ecstatic, right? It's releasing their pressure from their balance sheet and it's putting massive amount of pressure on the front of the curve, so long end rates must fall. Now, when you understand the relationship, as we've talked about on this show before, between, and I'm trying to hold these up so you can see them, but stocks, and I guess it's not going to work in treasury yields, have a relationship where treasury yields lead stock prices lower, on average by about 3 months. Now, this case, it's been a little bit longer because where did yields peak? Well, we can go look and say in this cycle, well, they peaked back in March. How about the S&P 500? Well, potentially peaked here. So now we're a little over 4 months later, right within that window. The average, again, is 3 months. It's somewhere between 0 and 6. So what the risk is we are about to have a major risk off event because there is a shortage of dollars, financial conditions are tightening, and the market doesn't see it. But now you do, and you know what you really need to worry about, and that's your investments, not your money markets. I'm Steve Van Metre. Thanks for watching. I also want to give a special shout out to my buddy, Travis Kimmel, the president of Real Vision, also known as Bear Lord. He helped me work through some of this, and I'm not saying for sure, but I have a hunch that, and I don't know, I'm just putting this out there, there's probably going to be a follow-up on this on Real Vision with he and I, and in the not too distant future. So again, thanks for being fans. We'll be back on Wednesday for the macro show. Bye now. The content of this video is provided as educational information only. Is not intended to provide investment or other advice. This material is not to be construed as a recommendation or solicitation to buy or sell a security, financial product, instrument, or to participate in any particular trading strategy. This video was prepared by Steven Van Metre. Personal capacity opinions expressed in this video that do not reflect the view of Atlas Financial Advice Inc. or Steven Van Metre Financial.